Good afternoon, ladies and gentlemen. Thank you for joining the second part of the second day of Slide to Open Ship Finance 2022. Our topic this afternoon as a starting point is alternative finance. By way of a very brief introduction, alternative finance started as indeed that, something alternative to bank finance, which had started feeling a little bit out of place in shipping about more than a decade ago. So alternative finance entered at that point in time to fill in a gap, but it has since matured, moved into adolescence, so it's attracted talented executives, knowledgeable executives, and now alternative finance has created a place of its own in its own right. So today, we do have five good friends and well-placed in their industries. Very briefly, Haris Antoniou, Neptune International. We have George Yanakis, Alantra, Martin Hugger, Meerbaum, Ilias Sakelis, Borealis Maritime, Vasilis Ofanopoulos, Mount Street. Join us for this live discussion right now. Gentlemen, thank you. We have two virtual guests. Nice to have you. Do you hear us well? Great.
Yes, we do.
Very good. So we're amongst friends here. So let's get started. If we compare where you are today as a segment compared to a year or two ago, what changes and shifts do you see in the way that you are approached by your clients, but also in the way that you approach clients and the projects that they wish to see financed? Martin, let's start with you.
Oh, first one, fine. Well, if I may go back a little bit further, we started in 2017 with the first deals, and no matter how many vessels you financed in your life, the first ones being kind of a 1, 2, 3, 4-man show are very exciting. So you have, when you work at a bank, you know that money comes from treasury and everything is set up. And when you do that in alternative finance, you need to redevelop things and you need to reinvent the wheel to some extent. And now, well, 100 vessels later, everything is running like it used to run in the past. And I think this is probably the same for most of the other alternative finance providers. You establish how things are done, people know you can deliver, they know how you work, you know how you work. So it has become a little bit less exciting, more reliable for clients. They know that we can be faster than banks, but we can also certainly deliver what we promised to deliver. So I think that's the main difference over the last couple of years.
Have your criteria changed, how you approach projects, which clients you target? Has this changed at all, or you're pretty much in the same subsector of shipping?
Pretty much the same thing, Angelos. We still have a focus on smaller family-run businesses, and we are maybe at the moment a bit more conservative when it comes to, say, container vessels that have high values. We still try to be anti-cyclical. We still try to beat banks on speed. So not much has changed, really.
We'll get to the anti-cyclical approach when we ask you later about how many container ships you plan on financing in 2022. But before we move on to that, let's just pick the brain of Elias on this same subject that Martin addressed. Has your approach, stance towards clients and projects changed, or pretty much smooth sailing, doing what you knew how to do best?
Thank you. Yeah, no, it's pretty much the same. The more important development, I think, and Martin did allude to it, is that probably 3-4 years ago there were a number of meetings you were going into, and you had to educate the owner of exactly what it is that you do and why you're different and how you're different to a bank. Today, you don't have to do that, and it's pretty well understood and well known, and therefore the word alternative is maybe no longer needed.
They switch in and out.
Direct lending. It's not.
Yeah, they switch in and out of it as if they were talking to a bank.
Exactly. The more important thing for us from a business perspective is, again, what Martin mentioned is to adapt to the cycle. And the biggest benefit of non-bank lending is the flexibility of the mandate in terms of LTV, in terms of age, in terms of segment. And that is the big business opportunity from a market perspective.
Not to mention that you have certain flexibilities built in that banks don't have. But maybe George can fill us in also on his approach, Alantra's approach to projects that come your way. Still educating people, or do you find that Martin, Elias and the rest and yourself have educated people enough that you now see eye to eye?
Thank you, and hi everyone. I mean, we are sitting more or less in the middle between, to some extent, the capital providers and the users of capital. So we get the chance to, have a little bit more information by sitting on both sides at the same time. There is definitely a lot of. I agree with both gentlemen that the level of education and knowledge is quite different from the owners. There is still, just in Greece, 650 owners, so there is still a lot of education to take place, I would say. But undoubtedly, the market has become much more efficient, and both the owners understand what to expect. What I see as a big difference is that they start having much more reasonable requests. So it's not just I want to borrow 90% of the vessel value without any employment, and I want to pay 300 basis points. They understand what it means, high leverage, and how much you have to pay for it, and what are what is the security package you need to be prepared to provide. That is also because the alternative or the direct lending, I agree with Elias, a much better word. The direct lending space, the non-bank lenders, let's say, have definitely also developed themselves significantly. And they also know how to approach clients and how to approach transactions.
So
I think both sides got educated at the same time.
And what you're telling us is that flexibility comes at a price, and that your client base understands the terms of this flexibility.
Yeah, at least to their vast majority. Yeah, I would say that.
Haris, how is it to wear a banking hat and now an alternative finance provider hat? And do you really need to change hats, or do you go into your meetings with very much the same approach?
Well, we produced really nice Neptune hats that we pass on to our clients, and they're a big success, I can tell you that. So the hat is the same. The reality, though, a bit more than 2 years ago, the whole team was on the other side of the equation, on the banking side of the table. And now we are, as you said it, in what you call alternative finance. But I'm a firm believer of the fact that what we now call alternative or direct finance is going to become mainstream. We've seen massive amounts of capital coming into the sector, not just from funds, direct lending funds, but especially from Chinese leasing companies. They are, really big, the sort of 8-pound gorilla in the room. But they have helped, in fact, the idea of leasing proliferate in the world of ship finance. So what we do on Neptune is we provide maritime leasing. We see that business expanding rapidly in the next few years. In fact, I did a parallel to aviation leasing, and it's an interesting statistics because in the 1970s, aviation leasing was about 1% of the global aviation fleet, and now it's more than 50. And imagine how much bigger the aviation fleet, the aircraft fleet is today versus the 1970s. So, and why is this happening? Because leasing is clearly a very flexible, available, and appropriate tool to finance real assets. And I think that's why it's going to proliferate, and that's why we're in it, I suppose, because we think there's a great future ahead.
Excellent. Vasilis, you're multifaceted in what you do. You're the jack of many trades in what you do. So why don't you give us your perspective on how you approach clients and how they see you and the projects that they bring to your doorstep?
Yes, so I mean, thank you for that. I mean, as a Greek, I feel comfortable with being a jack of all trades.
Didn't think otherwise.
You have to be in some ways. I think what we have seen over the last 1 or 2 years, I would say, is a transformation of our business as well as the business of most of our clients, whether they be banks or whether they be private credit funds. Firstly, historically, we have been focused in the shipping space. We have been leveraging our technology and our understanding of asset-based lending in the real estate market to enter into the shipping area. In the last 3 years, we have become the largest shipping loan servicer in the world, with over 8 billion of loans onboarded to our platform, some of them in Greece. We were historically focused, before COVID, we were historically focused on the NPL segment and kind of workouts from banks leaving the sector. So that was the bread and butter of our business historically. But increasingly we have entered, particularly responding to market forces both in the shipping world and in the banking world. We have been focusing on debt brokerage, so we raised debt for either to refinance exposures that we think can be refinanced or to generate new financing where it's not available.
And how are these exposures and the clients you cater to different than what you did a year or two ago?
I think it's not, the exposures themselves are not different. Shipping has not changed that much over the last...
And your approach remains the same as...
Our approach remains the same. What we bring to the table is an understanding that depending on the size, the asset class, the borrower, and the circumstances, there are different pockets of capital around the world available to step into the shoes of those lenders that move out of the sector.
So there are courses for horses, in other words, and we'll get to that a bit later in our discussion, but I will start off with where you left off, Hari, when you said that you expect that this space will grow for you because there's an abundance of capital around. So what I want to know is, how do you feel that the lowering of the pricing, because of course it's not what it is for the banking sector, but what we see in your space is that pricing has come down to the levels it was 2-3 years ago. Do you believe that this will influence the amount of capital that will come your way? Or do you believe that it's still at levels that will attract this capital moving forward, and hence a substantial amount of projects?
That's a good question. Of course, it always depends on the ability to provide adequate returns to investors. And of course, we need to ask ourselves, why did pricing, bank margins, reduce? And the answer to that is that we live, and we have lived in the past few years in an abundant liquidity environment with central banks printing money, buying bonds, et cetera, et cetera. So this is probably going to reverse. I don't know how soon because of the recent events, but still today there's abundant liquidity conditions. So that creates a lot of liquidity in bank balance sheets, which needs to be deployed.
And if you tell them they need to lower their return requirements, you can still attract their attention, right?
I think it just trickles down, basically. Everybody has to adjust their preferences and their requirements. And ultimately, provide exactly as I said earlier, the adequate returns to the investors. Now, if that doesn't happen, yes, liquidity dries up. And it's not a coincidence that liquidity in the banking market dried up when returns for the banking investors were not there, which is why we're all here talking about alternative finance today. But so far, it's just a question of the ability of the alternative financier to think in terms of solutions, to identify pockets of liquidity that were not there earlier, but are there today, and ultimately also use back leverage. I think a few years ago, this was not customary. However, it's becoming more customary, so I think this is why a number of alternative lenders are able to improve and reduce their pricing towards their clients.
George, do you need to change your pitch when it comes down to watering the appetite of your capital providers, or is it pretty much what it was a year or two ago, given the pressure somewhat on the margins that you're experiencing?
Yeah, I mean, that part I think has significantly changed. I mean, if we were to see our, let's say, syndicate of investors, I would say 18 or 24 months ago, you will have the lion's share being in the alternative finance world. Currently, this has changed drastically to having obviously banks coming in the sector, all banks that they used to be in the sector, new banks, new entrants from new geographies as well. Geographies obviously like Asia, the Middle East, but also the more European and US side. And that I think that definitely has created competition and has lowered a bit the margin. But I don't think it has lowered the margin to the point that it's nowhere close to become uneconomical or uninteresting to capital providers in the alternative finance space. I agree with Harris that one of the key reasons that the pricing has gone down from the alternative financiers is not just the competition, it's just the better financial engineering that there is available out there through back leverage to offer solutions. So I think it's healthy that you can go to a market where you have many players, that they can play in different levels of leverage across the capital structure, and in different structures. It's healthier both for the alternative lenders and also for the banks. Everyone has
keeps everyone on their toes for sure.
Yeah, correct.
Elias, how's the weather forecast in that respect for you in London?
Yeah, look, I will echo what George and Harry said. It's definitely the availability of capital from our perspective is improving. And I'm not going to repeat what the gentleman said. I will add a couple of points. If you think about it, the capital that we raise is institutional in nature. And this institutional capital today looks at shipping in a much more positive way than it was looking at it 2 or 3 years ago, for a couple of reasons. First of all, the last couple of years, at last, institutions have made money in shipping, which was not the case for the previous decade plus, and therefore you get more appetite to look at this asset class under different strategies and not only direct lending. But generally speaking, institutions are more open to come into this asset class as a whole. The second point is we are obviously living in an inflationary environment where inflation is a big concern, and therefore exposure to real assets, generally speaking, would be viewed positively. And therefore, from our capital raising perspective, putting aside the back leverage, which is also very, very true, but from the equity raising perspective for us, it's definitely a much, much better circumstances today than it was 2, 3, 4 years ago.
Circumstances for you, Martin?
Really agree with the fact that there's a lot of pressure on prices. I found that a year ago when we had the LIBOR dropping with the beginning of the Corona crisis from 2% to almost 0. But at the moment with base interest rates going up, I think the overall costs, and that means the overall return to our investors, is about the same as it used to be. What matters for most clients, from my perspective, is that you're there, that you can deliver what you promised to deliver, and that you're there speedily and reliable. and not really the last 10 basis points. I see some people trying to compete on price, but this is usually when you get calls from clients saying, we have a delivery on Tuesday, could you do this over the weekend? And I don't think it's a very wise choice if you are in this position.
Okay, so Vasilis, how about yourself? Are you getting frantic calls in this respect? How are your capital providers approaching this more competitive pricing environment?
I think the financing sector has always been competitive in shipping. It's just that people pay more attention to it today. I think the calls we get are never on a weekend, and I think that is a good thing. What we are trying to say, and the connecting thread between the old markets and the new markets, is that we need, as financiers, to keep the costs down of monitoring those investments, of underwriting those investments, and that is what we bring to the table. We try to help our customers not to reinvent the wheel, as Martin was saying. I think there is an efficient frontier, and approaching the right capital partner at the right moment in the cycle is the trick. Not everybody wants or can do anything, and depending on how flexible their mandates are, we think that negotiating and sharing the risks in an efficient way is the answer, and that's where we kind of try to give them perspective, because we have such a view of the market.
And just as you thought you might get away from discussing ESG, and while on the subject of capital providers, my impression is, but here's where we want your view, is that although there's a lot of discussion around ESG, it has not yet infiltrated deeply into a big part of the finance system. So my question to you is whether my assessment of the situation is right or wrong, meaning, do your capital providers require you to provide them with tangible proof that you are monitoring a number of guidelines towards the projects and the clients that you onboard? Are we still in the infancy of such process? Is it getting casually discussed at any rate? What's your feel? And what are your experiences to date? Ilias, do you care to lead in this question?
There is form and there is substance. There is no doubt that over time, the overall information and reporting requirements to our capital providers will increase. There's no doubt about that. It hasn't really started. I fully agree with you, but it is a matter of time, and it will get more and more. However, if you turn to the substance, most of the investors who want to put money to work through firms like ours look at ESG as a business opportunity. Effectively, they look at it as one of the structural reasons why banks will continue to restrict themselves to a very particular part of the shipping market, leaving a very large part of the market without access to that type of financing.
So in other words, what you're saying is you think that your more responsible clients are jumping the gun in this respect and themselves showing proof before you require that from them. Do I read what you say correctly?
Yes, I wasn't referring to people who borrow money from us. I was referring to people, I think your question was more about people
your capital providers.
Give us money.
Yeah.
Exactly, our capital providers. So the bottom line is they look at this as an opportunity. They look at it as an opportunity because it broadens the addressable market for direct lenders like ours, because banks are effectively restricting themselves to very, very few big corporate-style ship owners who can provide the Poseidon principle, if I can call it that, overlay to get access to that financing. The majority of this market cannot and will not.
Okay. Yeah, okay. So that's in line pretty much with what my feel here is. Hari, what's your take on where we are on this part of the process on ESG and capital providers looking at it, or only casually discussing it right now?
Well, we also look at ESG as an opportunity, but not in the sense that Elias mentioned earlier, which is basically arbitraging between the haves ESG and have-nots, and therefore let's deal with the have-nots because, you know, there's a big market out there. What we're doing is we're trying to engage proactively. We have drafted a very clear ESG policy, and we're going to be reporting regularly, you know, on an annual basis on our progress. And we're trying companies to go through the transition. I think that's the focus of Neptune Maritime Leasing. And we're seeing a really good reception so far. And, you know, what do I mean by transition? It means that not only do we engage in, you know, new buildings with the right type of technology to make sure that, you know, we make progress towards the decarbonization, but also we're looking at helping owners in their thinking process and in funding them, you know, for retrofits and everything else. So it's a dual approach, which is delivering fruits. And I think because it delivers fruits for clients, it also speaks volumes to the ears and minds of the investors that we see becoming more and more active. In fact, one of the first questions that I've been getting lately when I talk to institutional investors is also, you know, what about ESG? You know, do you have a policy? I mean, that now comes as a question ahead of everything else in a number of discussions.
Interesting. Vasilis, do you get forward questions like these nowadays?
Yes, I think increasingly mostly our larger clients, large insurance firms, for example, or subsidiaries that invest in or in private credit, they are very much focused on this. I think they expect that definitely the G should have been there forever, right? Good governance always has been a focus for a number of our clients. But I think the more specificity we get on what investors expect on the environmental side, not just literature and propaganda, but actual
hardcore facts.
Yes, that and measuring these aspects of all investments and cuts across all our four main verticals: real estate, maritime, aviation, and infrastructure. In all of these challenges and the new metrics that everyone needs to be constantly aware of if they want to address a larger capital pool and grow their business. I think that is something that we are becoming very good at, and set up a team to do that as well.
Excellent. George, have you had to compile a scorecard towards your capital providers in this respect, or not yet? You're still sort of compiling it but haven't released it yet?
I think that there are, I mean, we are seeing, because obviously we speak to both traditional, let's say, capital providers and alternative a lot. We actually see reverse inquiries almost, I would say, from more than the traditional lender space who seek ESG-related financing opportunities. So they actually go to I would say, the next step of not only replying positively to an opportunity, but actually seeking to have kind of a first look, if you may, one can say that, in something that has a lot of environmental friendly flavor in it. I think there are two risks there, and I agree with all the gentlemen that spoke before. Is that I don't think there's still the employment market. I mean, let's see what happens, obviously, with the super high oil prices for how long, but it's still not there to support that increased appetite. And at the end of the day, a loan needs to be paid out of cash flow. So it's important that that focus is supported at the same time from a market, so lenders can actually lend more preferential terms and give priority to environmental projects. And the second risk is, I think it's still unclear, not unclear, but not fully clear, what exactly a ship owner needs to do on his existing fleet to actually start becoming more and more compliant. And there we see from the capital users, so from the ship owners, a lot of doubt when you bring up the question, what's your ESG plan? Because you need to put it in an investor presentation that goes to seek capital. It's a difficult question these days.
Yeah, I think probably we need to expand the acronym to ESGT and put the technology part there, because that is an unknown today, and keeping people away from making the E a faster reality into our lives. Martin, what's your feeling in that respect?
It's generally mostly with Elias. I think it's a difference between form and substance. On the substance side, what we're all trying to do, we try to finance good guys, people that have a good name, that care for their crews, that make sure that the crew is sufficiently replenished with what they need. They are replaced from time to time and not just kept sitting on rotting vessels. This is something that is for us a very big concern. We don't like old rust buckets. We want proper maintained, environmentally safe vessels. We want owners that care for their vessels, that care for their crew, that don't do dodgy stuff. And this is the, I would say, traditional approach of you finance only good names, you don't finance fly-by-nights. And then there is the more formal approach. Do you have a policy? Yes, our refinancing banks, they want us to also show the form, and not only that our clients are good guys, but also tick the boxes and show that we actually, in a structured way, approach that and look that our clients not only conform with law, but go beyond that and have a proper governance. And what we're trying to do there is help the smaller guys to show what they need to show, also to be bankable after they leave us.
So it's moved past the superficial stage and it's moving into more fundamental. Yeah. Okay, great. So
well, you know that from talking to your owners when you wear other hats. It's important that you have a crew that is happy, that you have good vessels, that you have happy charterers, and this all goes down to good governance at the end of the day.
Absolutely. And speaking of other hats, when you and I worked closely and wore our banking hats, we were both counter-cyclical lenders, which begs the question of what cyclicality is all about in 2022. Are we at the peak of a cycle, or are all these ESG considerations the fact that a big part of the fleet will no longer be that marketable come 2023, 2025, with all the environmental constraints, yard space being constrained for certain types of new builds, all these parameters here? What does that mean? Do you think there's more room to finance projects today, or is it time for caution to step in, at least in some segments? Martin.
Yeah, I think counter-cyclical finance is something that you want to do. At the end of the day, though, there are two sides of the coin. There is one, the asset value at which you go into the cycle, and the other side is the cash flow. So if you're completely counter-cyclical and you do a Suezmax that doesn't even earn operating expenses, there is a way to structure that, but you also need to hope that a year down the road, when your liquidity cushions have been eaten up, that the market has turned. The other way around, if you do a very expensive vessel now, but you have the chance to hedge your cash flow to some extent, you can also do that with steep repayments. So at the end of the day, both is workable, but you have to have a view what will be after your initial TC cover or your liquidity cushion is over. And my personal view on that is that we have a good order book on the container side. something like 25%, I read yesterday in a newsletter, and inefficiencies that eat up around 10%, so 35% total vessels that can make it back into the market is a substantial amount. This will not come 2022, but it will come 23 and 24, so we'll see corrections there. And then it remains to be seen which liner companies honor the 3, 4, 5-year time charter commitments. We've seen that before, both of us.
Yeah.
So all of us, if I may say. We'll find that interesting. And in bulk, I'm with Petros Papas. You know, we are part of the Papas group. That 2022 and potentially also 23 is looking good on the fundamental side, and that yard space is very much covered by containers. And on tankers, it's $1 billion question. I just don't know.
There you go. Haris, where do you stand on that phrase, 2022, 23, bulkers and maybe other segments to be good? Or do you think cash flows will dry up, or are you prepared to finance the good projects in any case?
Well, what I see is that we all talk about counter-cyclical investments and lending, but there's also tremendous interest and tremendous deal flow at this point in the market cycle, which means that there are deals getting done at elevated values. Martin is 100% correct saying that, in container ship, we have a huge 35% of the fleet, in fact, coming into the market in a couple of years' time from now. And typically, our experience of the last, 20, 30 years tells us that this is not a recipe for success, generally speaking. So one needs to be cautious. Second, on dry bulk and tankers, no, let me first start with dry bulk. On dry bulk, there is a degree of optimism because exactly the order book is not there. It's like 7% or so of the fleet. And global trade is growing. Ton miles and definitely geopolitical events, have a role to play here also generally grow. So that means that eventually, and then if you add on top of that the slow steaming that we may be forced to go through as a result of the environmental regulations coming into place as of 2023, generally create a benign, let's call it a good environment for dry bulk.
For dry bulk.
Tankers, the big question that I have in my mind, yes, oil is still going to flow for the next few years, but there is a limited time span for that as we move towards the electrification of the transportation sector. It's not going to happen tomorrow, but in the long run, it's going to affect, in the medium run, let's call it, it's going to affect the demand for tankers.
George, your view on this matter in terms of where we are in the cycle?
Yeah, depends on the sector. I agree with both gentlemen. The fundamentals look very interesting, obviously in the tanker space. They also look very interesting, just putting another parameter here, in the offshore space, something we also spend a lot of time on. Definitely the containers is a big question mark. And if you have a crisis in the containers, it will feed in other, definitely dry bulk to some extent, sector as well. It's, Harris is absolutely correct. You get to see constantly deals getting done at these elevated valuations with long-term charters in place. And the big question mark is if everyone will keep on paying from the liners.
Yeah.
But yeah, I think tankers and offshore space are definitely the two more promising sectors in terms of fundamentals. And dry bulk, I think, has still a good pedigree to go from order book and demand.
Elias, have you earmarked these two segments yourself, or do you skew your judgment towards others also?
Look, I broadly agree with everything that has been said. Our approach and our philosophy always is we deploy debt at a time where we would have deployed equity. And that ensures alignment with the owner of this vessel, and therefore avoiding elevated prices is generally a good strategy. That's for sure. The second thing, however, is about, and I mentioned it earlier, what's very important for people like us is the flexibility and the breadth of the mandate. And I will pick up on one particular point just to make an example, to take an example of one of the things that George said. What we have been deploying a lot of over the last 2 quarters is in offshore support vessels, where we generally had a view on the oil and gas market. We generally had a view on valuations. And yes, you need to be very careful, but subject to structures, etc., you can do it. And that's one example where we have been deploying a significant amount of capital recently. Again, you need to be able to move away from just the very big sectors. There was a huge opportunity. Now it's played out, a year ago in multi-purpose heavy lift vessels. Huge opportunity. Obviously now the evaluations have run significantly. Same can be said about car carriers, which we haven't mentioned. Which again we deployed a lot, probably at the end of 2020, beginning of 2021. So you just have to
be strategic,
to find the relative value,
and be strategic in how you approach things. Vasilis, the end of this panel,
and George will know this. Yeah, sorry, and George will know this because we worked with, and you need to be disciplined enough to step away from projects and say, no problem, this is not for me, no problem.
Straight shooting and how you address.
Doing a good deal.
Excellent. Vasilis, this is the end of the panel, so the closing remark befalls on you to make in this respect. Just give us 30 seconds of your closing remark, and then we will thank you all for contributing your thoughts.
Thank you. I think counter-cyclicality is something that everybody aspires to, and usually we have been part of the cleanup of those people that got it wrong. But we launched our principal investment strategy with a team in London 15 months ago. We have deployed over 200 million in containers. It has gone brilliantly well. So for us, that was for a young firm, it's quite a good first success. I would have liked if we could find long-term charters attached to dry bulk. We could have replicated more of that in dry bulk, and probably will in the near future. I think on the other side, we thrive even when conditions are bad, because we've seen quite a few cycles as a team, and we are currently underwrite quite a few portfolios that are at various stages, either performing or non-performing, and we think there are going to be a lot of opportunity to deploy capital in the core sectors. We like some new sectors that are coming up. We live in a new world. A week ago, you wouldn't have thought that Germany would be building 2 new LNG terminals. Now it is a reality. So we need to all go back to our models for certain sectors that are going to change radically.
Absolutely. Gentlemen, we could continue for much longer, and our audience would really like that. But we'll probably renew this discussion for 2023 with a renewed agenda probably by then of new issues. Thank you very much for contributing your time and your thoughts. All the best with your projects, upcoming projects in 2022, and a good afternoon to our audience and one and all. Thank you.